Hi everyone, welcome back to Reit video segment, where in this video today, we'll be sharing more about how interest rates affect REITs. For those who has been following the news for the past few months, you would have known that in the entire world, we are badly affected by the COVID-19 pandemic, which has been affecting not just the healthcare, but also the economy, right? So in fighting the pandemic itself, various governments have stepped up to introduce various stimulus measures to help stimulate the economy. In Malaysia itself, if you look at the Bank Negara itself, they have made interest rate cuts twice this year. First in March the 3rd, and secondly in May 5th, where they make a further cut down to 2%, right? Not just in Malaysia itself. If you look at the United States, the Federal Reserve has taken the measures to cut interest rate down to zero as part of their measure to stimulate the economy, right? So when we talk about interest rates, what does this mean for REITs? And generally, how does interest rate affect REITs, right? So in this video today, we'll be sharing more about three things. The first being the borrowing cost and REITs itself. Secondly would be the dividend and how it affects investors. And lastly, we'll be sharing more about the positive and negative aspect of interest rate hike and cuts. So a very quick run through on REITs to help all of you to better understand the next 3 points is that a REIT is basically a vehicle which owns a pool of properties in which investors can invest in it and sort of co-own the properties, and in return we would then receive dividend. So the REIT, to acquire all these properties and to own all these properties, they can technically own it through two ways. One is through raising funds through equities, which is through your money, which through private placement, through rights issue, and of course during the IPO, right? Or they can also do it through debt financing, okay? But the caveat here that you all need to know is that every REIT has a leverage level that they have to maintain, where in Malaysia, the leverage limit cap is at 50%, and in Singapore, it was 45% with a recent announcement to bring it up to 50%, okay? So that's the first thing you need to know about REIT. We are very well regulated with a leverage limit cap, and to help fund the properties, debt are heavily used as well, okay? And of course, with debt, it comes with interest, which is why we are on this topic in the first place, right? And secondly, as what we have mentioned, the next key thing you need to know is that through investment in REITs, investors will then receive dividend, right? And REITs has to distribute 90% of their taxable income if they want to avoid paying corporate tax. And as such, dividends given out by REITs are usually fairly high with an average of about 5 to 7% generally, right? Not all, but generally. So as such, this attracts investors. So there are 2 points. First is that REITs are financed from debt and equity, and with debt comes interest expense. And secondly, REITs distribute a huge amount of their income as dividends, and with dividends, it attracts investors, right? So the two main things that you need to know. Right, now let's kick in. The first point we'll be talking more about is how interest rates affect borrowing costs and REITs. As what we have previously mentioned, to fund assets, REITs can do it through two methods, which is one, through debt, and secondly, through equity, right? But in this video today, we'll be sharing more about the debt portion. So the one thing that you have to know about borrowings is that with borrowings comes interest expense. So the ideal way is to pay less interest, right? The less interest you pay, the more earnings you get. And the more earnings you get, the more dividends investor received, right? So interest rates, cuts, and hikes definitely play a huge role in REITs, given their highly leveraged nature. So depending on how the REIT structure its loan, if it's a floating interest rate in which the loan are sort of pegged to the interest rate of the current economy, they are more likely to be affected by the hike and cuts of interest rate. To help you illustrate, let's say at the current period of time, you are paying interest rate of 2%, right? And the government introduced a further hike of interest rate up to 3%. So instead of paying 20k per annum, you have to now pay 30k per annum. So that's how a REIT will be affected by hike and cut if they are variable interest rate. Likewise, if they are fixed interest rate, in the short term, they won't be affected because regardless of a hike or cut, the interest rate paid are fixed. Let's fixed, say at 2% per annum, right? So regardless of a hike to 5% or down to 0.5%, you will still have to pay 2%, which is fixed, right? So for short-term, fixed interest rate loan are likely to be more stable, and variable interest rate loan are the one that will be affected by interest rate cuts or hikes, right? So let's assume there's a cut in interest rate introduced by the government. So a cut in interest rates would mean a lower interest rate expense, which is a cheaper borrowing cost. And with a cheaper borrowing cost, the investors would then have a higher distributed income, right? Lesser expenses, more earnings. The second point is that with interest rate cuts, it is easier to look for lucrative acquisition. So let me help you to illustrate better on how these work. Say a REIT is planning to acquire the fourth assets. Okay, the first scenario is there's a cut in interest rate where the asset would be valued at 1 mil and it potentially giving you a yield of about 10%, which is 100,000 per annum, right? The finance cost of this first scenario is at 2%, where you have to pay a 20k per annum interest expense, which give you a net 80k or about 8% yield. And in the scenario where there's a hike, similar asset, similar yield, but the interest rate is at 4%, which is about 40k per annum, the net earning would then give you a 6% yield, right? Given this scenario, you will notice that during interest rate cuts, it is easier to look for a lucrative acquisition because the higher expense you pay for interest, the higher yield you have to find on a property to make the investment lucrative, right? So that's about it. And the next point is about how interest rates affect dividend and investors. One of the main factors why investors like REITs is because of the high dividend, where on average you earn about 5 to 7% of dividend, right? If we were to look at the Malaysia interest rate, it has always been about 3%, that range over the past few years. Of course, there are times where it spiked up and there are times where it went all the way down to 2% during crisis, right? And even now itself. And secondly, if you look at the Malaysia government bond, bonds are deemed to be a rather stable investment compared to equity. During times of interest rate hike or during times where government bonds are giving out yield which are very high, if you look at these 2 points, where interest rates will give you about 3.5% and a government bond will give you about 5% yield, this is rather similar to a yield to a REIT. And in times where interest rates are higher, where yields are better in FD or government bond, investors would rather put their money in FD or government bonds, which are deemed to be a more stable investments compared to REIT, which would fluctuate based on the market sentiment, right? So that's how dividends affects investors. During times of cuts, interest rate drops down to 1% or 2%, REITs deemed to be more attractive because they give out better dividend, where you get 5 to 7% as compared to 1% of interest rate from FD, right? But in times where FD goes up all the way to 3 to 4% as compared to a REIT average yield about 5 to 7%, it makes sense to invest in an FD as well because it's more stable. Of course, this is based on investors, right? And thirdly, we'll be sharing more about the positive and negative aspect of hike and cut. We'll start off with rising interest rate. With rising interest rates, investors can expect the economy to be growing, and with growing economy, it means greater earnings are expected, and this is sort of more than enough to offset the high interest expense, right? But the negative part of interest rate expense hike is a higher borrowing cost, making it harder to find lucrative acquisitions. REITs have to compete to find the best acquisition out there in the market. And secondly, REITs which are floating rate interest in nature, which are variable, will be affected by the increased interest expense because a hike means they have to pay more interest expense. And thirdly, a high interest rate means investors have options to invest in less risky instrument while getting the similar decent yield. And secondly, we'll be sharing more about how a decline in interest rate affect REIT, right? The positive aspect is that when interest rate decline, borrowing costs are generally cheaper to raise capital for further acquisition. So instead of paying 5% interest rate on the next purchase, you can easily get financing at 2% or maybe 1%, for instance. So it's cheaper to finance acquisition, and with declining interest rates, REITs are more appealing to investors because other instruments are giving low yield like FD, and REITs are giving a better higher yield to investors, and this is why investors will be more attracted to REITs during declining interest rates. However, the negative aspect of declining interest rate is that it's a sign that economy are slowing down, which is why the governments are putting in measures to help stimulate the economy by cutting interest rates so they encourage people to spend more money, to get more loans to help stimulate economy in a way. So that's it about how interest rate affect REITs. Hopefully this has been value adding to you. We hope you like this channel. If you like this channel, do click the like button and subscribe to our channel, and do follow us on Facebook and Instagram, and do share it with your friends if you like this video.